Afternoon, good evening, wherever you might be. Everyone, thank you so much for joining us for our April recruitment roundtable. We have Dr. Solange Charas joining us today. I'm super excited. We've been nerding out for the last 30 minutes as we are getting ready to start today. And we are going to talk about, I think, a topic that Dr. Charas is super excited about, maximizing human capital investment to drive ROI. So what do employers need to think about and know in order to make sure that you are getting the ultimate ROI out of your human capital investments? I'm going to give you a little bit of background, and I'm definitely going to do you absolutely no favors in this one. But Dr. Charas is the founder and CEO of HC Moneyball, is a book that she has also written. You should read it. Go buy it right now. It's very interesting. She's a member of the Human Capital Technical Advisory Group, and which is part of the International Organization for Standardization. She's a professor at Columbia University, or lecturer at Columbia University, right? And an adjunct professor at the University of Washington, the University of Southern California, and NYU. You are a board advisor for the Strategic Human Capital Institute. I can't even get through all of your experiences. You have such cool experiences. So I know, me too. And this is your world. And today we really want to spend some time diving into how you calculate, how you really think about the numbers when you think about your human capital and your human capital investments. So I will start by saying, Dr. Charas, is there anything you want to add to the lengthy things I've already started? Because you have some practical experience in an employer at an earlier part of your career, right? You worked in employers, in human resources, as a chief people officer. Am I correct on this statement?
Yeah. So my career spans being a client server at companies like the Hay Group. Anybody familiar with the old Hay Group? Ernst & Young, or actually they're called EY. So when I was there, it was called Ernst & Young. Now they're called EY. Arthur Andersen, Towers Perrin, which is now part of Watson Wyatt. And also as a corporate person. So I was the chief human resources officer for 3 professional services firms, where, as you know, in professional services firms, human capital is, the most strategic thing you need to manage to deliver services to clients. So I've had both corporate and consulting, as well as educational experiences. So I've seen it from both sides. I think there's a good song lyric in there someplace. So delighted.
You like to talk about ROI of human capital. This is a big topic for you. You spend a lot of energy in teaching and writing about it. Can you break this down? Help everyone understand what is HC ROI? What does it mean? What do you think about? Like, give us all of the component parts.
Yeah. So HCROI is human capital return on investment. And the reason that it's so important today to measure human capital return on investment is because of the shift in most organizations' focus and investment on human capital and people in the organization. And we had a really awesome thing happen a couple of years ago, where the SEC said that human capital is not an expense, but it is an investment in an intangible asset. So a couple of things about that. And we didn't talk about this, Leah and Alex, but can I share? Do I have some slides that
Oh, there's slides. You guys, this is going to be exciting today. I also failed to mention that I'm Leah, and I lead JobSync's commercial business. Alex is with us today, the CEO. I just failed on all fronts today, guys. Sorry. And JobSync, for anyone just joining us, is a platform or hiring operations platform. We live in between sources of candidates and tracking and optimization systems for candidates, and help make companies as efficient as possible in their recruiting efforts, which of course is going to tie right into our ROI conversation. So a huge failure on my part just to get us started properly. So I apologize to everybody on that. Sorry for interrupting. You can keep going.
No
My
problem.
slides.
No problem. So when the SEC said HR people it's not just an expense, it's an investment in an intangible asset, it triggered a couple of things. The first is when you associate the term investment, what automatically comes up is return, right? Like all of you guys in the room have some experience with investments. You invest your savings, you make an investment in your homes, right? And when you make decisions about where to put your money, you make those decisions based on an expected return. So when we now reclassify human capital as an investment, we have an obligation to monitor and show a return on that investment for stakeholders. So that's the first thing that comes up is, oh, investment requires a return. So HCROI, human capital return on investment, is the mother of all metrics that help organizations show the return on investment in human capital. So that's the first thing. The second is the slide that I'm showing you. This is research that was done by Ocean Tomo. And if you haven't seen this before, congratulations, you're seeing it for the first time. And I promise you this won't be the last time you're seeing this, because almost everyone that talks about investments and intangible assets and disclosures uses this, this little schemata, this little graph. And it's basically showing that Ocean Tomo studied the S&P 500 to understand what is driving market value for those organizations. And they looked at it historically, and what they found is intangible assets are making up more and more of a company's market value over time, to the point where in 2020 of the S&P 500, 90% of their market value is driven by intangible assets. Intangible assets are those things that we can't touch, right? So tangible assets are going to be things like real estate, desks, computers, products, and intangibles are services, right? The contribution of humans to value of the organization, the economic value creation. And I'm going to throw this out to you guys. So what happened between 1985 and 1995 and beyond that really tipped the scales in terms of intangible assets driving value? So can you guys think of something that happened in the early 90s that actually changed the way our economy, our businesses are valued? Anyone?
Changed in the economy
Bueller?
in the 90s.
Bueller?
Yeah, the
Internet is from Leanne Byman. Jump in. Do not need to just use the chat. Although the chat is available, you guys, for a secondary conversation that anybody wants to throw out.
You're absolutely right. Does Google make anything? No. Does Facebook make anything? No. Does Yahoo make anything? No. They don't have tangible products. Their value is driven by intangible, by services, by creating networks that you can't touch. And so our economy sort of began to shift to organizations, companies having a lot of value, but not creating anything. Not like GM, where they produce cars, right? Or Intel, where they produce chips, or IBM, where they produce computers. Even IBM is now mostly, and also Intel, leaning towards intangibles, right? Apple, a lot of its value is intangible. So we're seeing the composition of the attribution of value in organizations to intangibles. And what are humans? What is human capital to an organization? It's intangible. We can't own humans. I remember my boss and I used to ride up and down in the elevator. We used to be the first to the office and the last to leave. And at the end of the day, he used to say to me, and I worked for an insurance company, I worked for a professional services firm. So he was my CEO for the insurance company. And at the end of the day, we would ride down in the elevator and he'd say, so, what's keeping you up at night? And I said, making sure that our people come back in the morning. They leave at night. Our assets leave at night. My concern is that they come back in the morning. And he said, what are you going to do about it? And I said, well, I'm doing the best that I can. But my problem would be solved if I could nail their feet to the floor. Right?
Keep them.
And keep them. So, human capital is really important, and being able to measure the return on our investments in human capital is going to become increasingly more important for us as human capital professionals to show our value to our stakeholders being our investors, our customers, our employees, our strategic partners, and the communities in which we work. Let me show you another.
You got another. Okay, go ahead.
Chart. We are continuing to shift to services that drive our economy. So take a look at this chart, right? Services now make up 87% of our GDP. How do we deliver services? Through people. So people are becoming more central to the way that we run our businesses, the way that we create value. And it's incumbent upon us as human capital professionals to quantify the value contribution that we make to organizations' success, sustainable success. And HCROI is, as I said, the mother of all metrics when it comes to that. So maybe it would be helpful if I talked about what the algorithm was on how to calculate HCROI.
Yes, I want to just make a comment real quick.
Yes.
So one of the things that was obvious for me as you're speaking is this isn't about knowledge workers. Like the market likes to talk about knowledge workers. And what's really interesting about this isn't about a knowledge worker per se. This is about a service worker, a knowledge worker, any person who participates in a business in some way has knowledge, but also has output, has productivity.
Yes. Yes.
And so we have to make sure we're not biasing the way we think about human capital ROI through that lens of the knowledge worker that we tend to bias towards when we think about these kinds of ROI calculations. Right. Would you agree with that? Am I on the right track?
Absolutely. Absolutely. Yeah. We think about the labor input into the business model. McDonald's has a business model that cannot survive without labor. You need somebody to make those hamburgers, to flip the burgers, and somebody to interface with the public to deliver that service, right? To deliver the product. And I know that a lot of businesses are trying to figure out how to shift their dependence on humans to deliver products and services. And I think that's brilliant, like using AI and using Gen AI, because I have another chart that I can show you. The labor pool, available labor pool, especially in the United States, is shrinking, right? They're saying that baby boomers, I'm a baby boomer, are retiring, some say at 10,000 per day. I don't know if it's that high, but what I do know is that we're seeing a shrinkage in the available labor pool in the United States. So this is showing you the demographic shifts and the projections. So you can see that the age 65 plus is the only part of our demographic population in the United States that is growing. And that's driving the total age of the population. You can see that every other population group is pretty much flat. So as the baby boomers retire, we don't have enough people to fill those open jobs. And smart companies are saying, if I can't find talent, I need to figure out how to fill the gap in the labor part of the business model.
Yeah, last year alone, we calculated in the US that we were 2 million people short
Right.
for the needed labor
Yeah, and that makes
available.
sense. That
Yep,
makes sense.
and
And that's about the number of open positions we're seeing in the economy, right?
yep. And as we move forward, right, the projections for 2030 globally is about 85 million. So this isn't a US problem. This is a global problem.
This is a global problem. But
Yeah,
we all sit in the US, so that's our, our line
reference.
of sight is how do we help our companies not only get talent, keep talent, but show from a materiality perspective, from an impact perspective, that we are effectively managing and deploying human capital in the organization to drive sustainable business outcomes. So HCROI, let's get back to the algorithm, is really easy to calculate, super easy to calculate, super easy to track over time, super easy to correlate to other financial performance indicators. And this is what I teach students is when we think about human capital, we shouldn't just think about managing two human capital performance indicators, KPIs. We should think about how human capital is impacting business outcomes. So Dave Ulrich would say, we don't do HR for HR's sake. We do HR to support the company being successful. And what he also says is the most important thing that HR can do for employees is make sure that the company is successful, right? It's not about providing training or, job opportunities or pay. HR's obligation is to make sure that they manage human capital in a way for the company to stay in existence, because the company goes out, nobody's got a job. So that's
so
Dave.
interesting. So you're thinking about it through the lens instead of, individual, keeping people happy, whatever benefits or perks or pizza or whatever it might be. It's really about an operational function, right? How do we operationalize and our deployment of a resource that we have?
Exactly right. So our goal shouldn't be are employees happy? Our goal should be, are we delivering value through employees to the company? And if that means making employees happy, then that's what we should do. But the end goal should be an organizational level goal, not an HR level goal. What we do in HR drives that outcome. So I also don't want you to think that you shouldn't, that I'm saying, oh, don't think about your employees' engagement or your employees' experience. Think about company profits. I'm not saying that at all. I'm saying that you should use what you have to drive outcomes for HR that support the company being successful. Right? It's a pathway. It's not a destination.
Yeah. So there's this debate raging, as you know, has gone for a very long time. Is talent attraction, talent management, and HR, do they belong all together in a singular function? Or is there really an argument to start to separate these out and start thinking about them in different veins? Should talent be its own set of functions and things that activities where HR around benefits and payroll and employee resource groups and all of the component pieces of labor relations, do those actually belong separate in order to maximize your entire talent resource that you have?
Right.
It's a big question. Sorry, and I didn't prep you on that one ahead of time.
I don't know how to unpack that question.
I think what you would say my takeaway from what you've talked about is, all right, so if you're going to run that experiment, baseline where you are before, and then calculate and measure where you end up if you implement it, and did your ROI on your human capital investment improve or not?
Exactly. Exactly. And by using metrics, we can actually anticipate what the return on investment is going to be. And that's, we need to, so let's back up for a second. So the human capital function is really complex. It's more complex than any other single function in the organization. So when you talk about should talent management be part of HR or outside of HR, I don't know that it really makes a difference, because we're still talking about, you might be talking about an apple or an orange, but it's still a fruit, right? It's still the labor input into the business model, whether or not you have the separate group managing talent or it's, integrated into the whole under the human capital umbrella. It really doesn't make a difference. The idea is it's a complex function, and it is a multivariate function. There isn't one thing that drives outcomes. It's the interaction between things in HR, right? It's getting good people and then training them and then making sure that they have some type of an experience that is satisfying to them so that they stay and that they're productive, that they're inspired, that they find purpose. All of these, is it one thing? No, it's not one thing. It's a combination of things. And the combination of things is going to vary based on every organization, their culture, their climate, their leadership, their purpose, their mission, their customers, right? So is there a one size fits all? No, that's the art. You need to figure out what levers you need to pull or dials you need to turn to generate the best outcome for the organization in terms of human capital, productivity, human capital, sustainability.
I think it all roots back to the point of you're doing this because you're expecting a return on investment, and that
exactly right.
These are investments. And so actually, as you were describing it, I think about like sports, right? Like really the HCROI is like the final score of the game. Whether or not you won the game was really determined how you played throughout the whole game.
How you played your players.
Yes.
Right? How you played your players, how you trained your players, the mindset of the players, right? And that mindset is going to come from coaching, from a climate in the sports team, right? It's a great analogy to say a company is like a sports team, and whether or not they win has to do with how you're managing the talent on the team and creating a context for them to be successful.
Yeah, we were listening to a guy give a talk yesterday, and it's the guy from Temple Health, and he was talking about the Chicago Bulls being the best basketball team, the Jordan era Chicago Bulls, because they had very specific position players, right? Like, one person's like the best person at assists ever, best scorer ever, best rebounder ever, best defensive player ever, all on one team, hyper specialized positions, just as an example of compiling the proper team to drive an outcome.
So you're talking about the Oakland A's and Moneyball.
Yeah, Moneyball. Yeah.
Right?
Oh, there you go. That's a nice drawback to the beginning.
You think it's an accident that we named our company HC Moneyball? Because it's all about using analytics to figure out how to improve the performance of the players and the company and the team to drive value creation. Yeah. So the whole idea is, and I was a human capital practitioner as a corporate executive, as a consultant. I know how important your gut is. I mean, that's what makes some HC practitioners brilliant, is that they have really good intuition. But you have to back up the intuition with facts and data, right? The intuition will help you come up with the hypothesis, but then the data analytics will either prove you right or prove you wrong. If you're right, then you've got data to back it up, and you can go to executive management and say, I've got this recommendation, and here's the data that will support my recommendation. Instead of saying, here's my idea, I think this will work, right? And we want to move HR out of the dark ages where we're basing our decisions on superstition into the modern era where every function in the company uses data to support decision-making, except HR. Even marketing uses data analytics now, right?
We were listening
So-
yesterday to a conversation around hiring, and we like to talk about the bias of hiring, right? People have lots of biases in hiring. And the one that I heard yesterday, which I hadn't really thought of previously, which I think is super interesting, and goes to your point about data and the lack thereof, is we hit an urgency bias on hiring,
Right.
right? The pain of we need to fill this role right now causes us to make poor hiring choices because the urgency gets in the way of the data.
Exactly right. I have a perfect story for that. My CEO said we need a CFO. And so I said, give me a month, let me find somebody. And I engaged Korn Ferry. We came up with a slate. We were working through it. And then one morning he comes in and he said, I offered our ex-CFO, our old CFO, a job. I said, why did you do that? You know he's not the right person. He said to me, my basement is flooding and I need a plumber today. And that's how he made the decision to hire a guy that he knew wasn't right for the job because he had a flood in his basement and he needed somebody.
Well, the CFO is going to help with the flood. I mean, you should have hired a plumber.
Okay, so that's the metaphor. I'm putting in the chat now the algorithm, the formula to calculate HCROI, and we can unpack.
So when you get into a conversation, let's say with somebody, I had a conversation with somebody yesterday who was talking primarily about candidate experience and the need to improve the candidate experience and that they should make an investment in candidate experience.
Right.
Which is a very soft, I mean, I think we believe very strongly that candidate experience drives amazing outcomes, but this person was expressing frustration with the fact that they were being met with a challenge internally about, okay, well, what's the impact? Like, Is it going to save us money? Is it going to generate more revenue? What's the impact? And this person was kind of like, no, I can't quantify that. It's just going to improve the experience. How do you help that person jump that gap?
Yeah, and that's why I say that HR is not a univariate experience. It's not a univariate function. So there's some underlying assumption about candidate experience, right? We believe that if we can improve candidate experience, we'll be better off. But how? And that's the rub. The rub is, how do I articulate what I think the benefit is of investing in something to get an outcome? So I'm just following your lead, Alex. There's some assumption that says we'll get better outcomes if we invest in candidate experience. Now, how do I measure the benefit of that? So I could say my offer to acceptance ratio is going to go up. My employee net promoter score is going to go up. My Glassdoor ratings are going to go up. My average tenure, or let's even make it shorter in terms of a time frame, my first year tenure is going to go up because I'm improving the experience of the candidate, right? So you have to sort of think about what measurable outcomes am I trying to generate with an investment to improve something in the organization? And then I would say to that person, I'm assuming that they know how to measure, or they're gathering data on candidate experience somehow, right? Either the candidates are saying, overtly or, not directly or indirectly, I had a great experience or I had a lousy experience. Or you can go to candidates who have rejected a job offer and ask them why. right? Was it their experience? Did the job take too, did the process take too long? Were the hiring managers or the screening people or any interaction they had with the company not positive? Gather data and analyze that data based on historic information. And then you can say, oh, look, these people, we've interviewed 100 people, 80% of them that said that they had good experiences actually accepted the job offer. And the 20% that didn't have reported having a bad experience did not accept the job offer. So right there, you've got a metric, right? Or you can say, in the first year of tenure of the employees that you have in your company, you can survey them and say, how good was your experience, right? Through the recruiting process. And, interview or survey people who have left within the first year so that you have two groups. You have a group that's left within the first year and a group that stayed for the first year. And you can see whether or not it had anything to do with the candidate experience, right? So we have to stop guessing. We have to start using data to understand what's driving what in the organization from an HR perspective. Does that make sense to you?
Yeah, and I think you have to see it further, right? You actually put a number on it and a number, a dollar number, right? So,
Exactly.
right, it's good to say, yes, our offer percentage went up, but did those offers turn into revenue quicker? Did they turn into a faster onboarding or a better onboarding? What happened in the numbers that turns to you originally used the word stakeholders, right? How does this turn into value for our stakeholders, which is a term that I'm hearing more in recruiting in HR in the last year than I think I've ever heard before, which is really great. Right? We're starting to see more and more organizations think about the outcomes to the stakeholders, which is a very different point of view than, to your point earlier, which is this squishy feeling that things are better or worse, and that's how we measure.
So what I'd like to do is I want to unpack the algorithm for HCROI. So anyone that's in this room can see how easy it is to calculate it for their own company and track it over time. And then I want to show you a slide that helps human capital practitioners understand how to translate what's going on in the human capital function into financial indicators and then into levers that you can impact that drive sustainable financial outcomes. So how do we connect the dots between what's happening in HR and what's happening on your financial performance? Because that's really what your executive management is going to care about, right? The CHRO can go into a CEO's office and say, oh, our culture is not as strong as it used to be, or employee engagement has taken a hit. And the CFO doesn't know what to do with that, right? It's just noise for him because it's not actionable. Whereas a CFO goes into a CHRO's office and says, oh, that last deal we did didn't have the ROI that we expected, or our quick ratio is changing, or our inventory turn ratio is not as good as it used to be. The CEO basically understands what needs to be done because they know what the financial impact is of that kind of performance. So what we need to do is have human capital professionals speak a language that financial people can understand. And HCROI is a great first stab at this, where you can go into your CEO's office and say, last year our HCROI was this, and this was what our profitability was. This year our HCROI is higher or lower, and it translates into profitability because we use the same numbers to calculate both. So if you look at the algorithm, HCROI essentially is revenue minus expenses adjusted for the total cost of workforce. So everything you spend in HR. So what we're doing is we're creating a denominator that is adjusted profit that is taken out all of your human capital cost. And then we're dividing that by the human capital cost. So for every dollar we invest in our workforce, what is the adjusted profitability that's coming back to the company? Right? So you can see how when we say HCROI, it's a pathway to profitability, a profitability measure. And you can teach your CEO what this is. I mean, it's not going to be that hard for your CEO and your CFO to get this metric, and then speak that language to them. And what we found is for organizations that spend more than 50% of their expense on people, which in this country, 82% of our economy is based on services, and we need people to provide services. So for most organizations, they are spending somewhere near 50% or more on people. It really moves the needle on profitability performance when HCROI goes up. When you're better able to manage human capital performance, it has a direct impact on profitability. That gives HR people a lot of power. Yeah.
Which is fascinating, right? Because the other trend that we're dealing with is that the head of HR, the leader of talent, the leader of the human capital group are rarely as the SEC likes to characterize them, one of the top 5 paid or investment people, right? In fact, we are oftentimes seeing the leader of HR, the C-level person, at less than half of the salary of some of the people in the top 5.
That was my experience when I was a C-suite executive. I managed the single largest part of our budget, and I was paid less than half of what the other peers' reports to the CEO were paid. I always thought it was because I was a woman and not because I was HR.
It could be both.
Yeah. So my husband
Probably
likes to say, why
both.
can't it be both? But it is something that is getting a bigger and bigger spotlight, right? That we are holding a person responsible for, to your point, the largest budget line item, the humans, that
Yep.
this there is knowledge now and data around, the retention, for example, of your high impact employees and the work you do to keep those employees, and how that has an outcome on the business, right? That actually can change your ROI, your human capital, right? So lowering your churn rate, accelerating your hiring rate. So one of the things I know you like to talk about as well is the inefficiency in the hiring pipeline, that we talk to 100 people to say yes to one of them, but we still have to talk to 100 of them. And we pull not just HR resources to do that. We pull the entire company resources from an interviewing standpoint, a decision-making standpoint, the highly inefficient process to make a decision that oftentimes is actually turns out to be the wrong choice.
Right. And that's what I teach my students as well, is that when you think about making recommendations, you need to understand the statistical significance of that. So is your recommendation actually going to affect change and positive change? And also think about the economic significance of it. So I tell my students, don't go shooting squirrels. Chase elephants. Go hunt elephants. Don't hunt squirrels. Make recommendations and changes to HR, programs in HR that will have a big impact, not a little impact, because you want to be able to get the biggest bang for your buck. You're going to invest dollars in a program that's going to actually generate value for the organization. And what does value look like? Value ultimately is going to be measured by HCROI. So what's the return on investment of every dollar that you put in a program? So the other thing I teach my students is lots of places to invest money. You can invest money in recruiting. You can invest money in learning and development. You can invest money in mobility. You can invest money in ERGs. Where are you going to get the biggest bang for the buck? And I don't necessarily mean a financial bang. I also mean an impact bang. So what do employees want? And that's also what we talk about in the book, is really understanding how to segment your workforce, listen to your workforce, and make decisions that are going to impact the majority of people, not the squeaky wheel, which is often what happens when we make decisions not based on data.
So it's interesting. There's two things in what you're saying that I think is hyper relevant to the space right now. One of them is that we definitely see companies investing in a lot of technology with hopes and dreams.
Yep.
Better candidate experience. Don't know what that means on an outcome basis, because we have flooded the market with vanity metrics that these companies are leaning into, right? Like, it's super important that you have a higher conversion rate. Let's use that example. Like, for every person you talk to, it's good to have a higher conversion rate. We just talked about how inefficient it is, so it must be good. But what if you're having a higher conversion rate with the wrong people?
Well,
Right?
you find that out pretty quickly, right?
But on an investment you've already made,
On an
right?
investment you've already made. Yeah.
Yeah. And so
So
we're definitely seeing this become a stronger and stronger trend where companies are making investments on what I think are vanity metrics, is a good way to say it. And they don't know how to then take that through and say, maybe I made the wrong choice.
yeah, that's unfortunate. And I think, you know, as I said before, even with the example that Alex brought up, which is, you know, we want to have better candidate experiences. Well, what do we expect? What is the benefit that we expect from improving a candidate experience? And is there the right cost benefit there? So when you think about these vanity, you know, technology platforms, what is it that you expect the organization to benefit from? And then use data to figure out whether or not you're on the right track.
I think
Before
it's often just a check the box exercise. We need a thing that does a thing that does this, and a thing that does that, and a thing that does this other thing. And like, that's the benefit, but it doesn't tie to some specific business outcome that is going to actually help propel the business forward.
Okay, so that's a good segue. So the first thing I'm going to share with you guys, and I put it in the chat. So I gave you the HCROY algorithm, but a lot of people don't like to do math. So we've actually created a calculator that will calculate HCROY, and will also give you sensitivity analysis that says, if you can improve HCROY by 5%, what is the accretive impact to profitability? So I've given you the link to our calculator. You can get to it through here or get to it through our website under resources. So our website is hcmoney.com.
We'll send this out in the follow-on email with the recording.
Okay,
so
cool.
I'll put it there too.
So all you have to do is enter in a few data points, right? It's pretty straightforward. It's pretty simple. We do not keep any data that you put in the system. So you can go ahead and put in your own company data or not, or just use it to play or test. We don't keep any of the data that you put in. The only thing that we do keep is, to get into the site, you have to give us your name and your email address, and we're going to add you to our mailing list. And if you don't want to be on our mailing list, just opt out. But we're using this as a contact magnet. So the only thing we keep is your, name and email, but any of the financial data you put in, we don't keep at all. So there's no risk to using the calculator. And to use the calculator, you only have to put in 4 pieces of data: your revenues, your expense, your profitability, and the percent of total expense that human capital represents. Right? So it's on a slide scale from 0 to 100. And once you put that data in, we'll calculate the HCROI for you and the opportunity. So if improving HCROI by 5% generates $30 million more in profit, how much of the 30 million are you willing to invest to improve HCROI? And again, HCROI reflects the cumulative performance of human capital. So you might say, oh, we need to do recruiting better, we need to do performance management better, or we need to do succession planning better. I don't know what you need to do in your organization. We're just showing you the opportunity of improving HCROI from a financial perspective. So the other thing that I wanted to show you, and I'm going to share my screen again, and I'm happy to share these selected slides, whatever I showed. So, I mean, you'll see it in the recording anyway, but happy to share the slides, is this translation mechanism. So how do we manage companies to sustainable performance? We look at revenues, we look at cost, we look at how we can leverage our asset base, and how we can manage our liabilities, right? So we have income statement and balance sheet items captured in these key levers. That's what your executive management is looking for. It's looking for, how can I move the needle on these key levers through human capital performance, right? And revenue is sensitive to volume and price. Cost is sensitive to cost of goods, operating expense, especially around people, human capital cost factor. Assets are sensitive to fixed assets, intangibles, the like, right? And what we've done, and this is not my work, I'm going to show you a slide of my work in a second. This is from Oxford Rethinking Performance Initiatives and Schroders. And I've given you a hot link to it so you can see it. It's not proprietary, it's what's out in the world, but it helps you organize your thoughts around what's going on from a human capital perspective, driving these financial outcomes and levers. So how do you drive volume and price? Well, you can do it through strategic workforce planning. You can do it through driving a better culture. You can do it through designing better incentives that will impact customer service, innovation, right? Revenue generation, better products, right? Let's drop down here to operating expense, right? How do we manage human capital operating expense? We do it either through creating the right incentives, and I'm not talking about, performance incentives. I'm talking about any type of incentive that drives behavior in a positive way. So it could be a cash incentive, it could be some type of a recognition, it could be learning and development, anything that the employee perceives as value is a way of driving better outcomes, people outcomes. Creating a better culture, right? Getting the right talent, keeping the right talent, creating a culture where innovation is valued, right? And this could be both people and non-people based rewards or programs. So if you want to drive costs, right? What's one of the most expensive things that companies experience in terms of a cost?
Payroll.
Attrition.
Oh, I see what you mean.
Yeah, so you have fixed cost and variable costs.
Unwanted attrition.
Attrition is so costly for a company because
So
not only what?
Here's an interesting thing about framing that though. So you take a company like two examples, Bain and McKinsey, both of which have fantastic alumni networks. And the existence of the alumni network, they invest in the people that leave to be able to continue to get together, which then makes the process of attracting talent to come in, like highly qualified young talent to come in early, is because that's a pathway to get to that alumni network and becomes part of the incentive plan. So they took that point that you made about attrition and being a negative, they turned it into a positive through a kind of a fairly extremely intentional
Right. But
approach.
again, that is an intangible benefit to the employee, is that they get to join this network, right? But when do they start experiencing the benefit of that network? After they leave. That is a long-term investment, right?
It's interesting, right? So it's still a positive, but the attrition itself is still a net negative to the business, right? So even in having that
definitely
network,
net
which is helpful, you're still losing that knowledge worker at that
Sure.
point, and that's a.
And
And I think Trevor here was making a point of that it was a hidden cost, right? So it's not even like a line item that you see and you can really get your head around, except for we do see it in interesting ways. So for some companies, that attrition means you have to bring in temp workers, or you have to take your existing workers and pay them overtime, or you need to start shifting workers from different locations or shifts, which has a compounding attrition factor to it as you overexert your existing workforce, right? So there are these other ways in which that it's not just a straight line that you've lost that worker. You then have these knock-ons that can make it worse.
Here's something that, and you're absolutely right, and Trevor is absolutely right. It doesn't show up on the financials directly. It shows up in the financials indirectly, right? And you're absolutely right. Management does not take the time to understand it. So I'll give you an example of a client that we've recently worked with. And I want to do a shout out to Kim Hoover, who's in the room, who's on my team. So thank you for being here and working on this project with me. We recently did a project for a company in the professional services industry where they their average pay per employee is about $85,000 a year. The average productivity allocation per employee is about $280,000 a year. So they pay people $85,000 a year to generate $285,000 of revenue. That's about 2.8 times their pay. When they think about attrition, the financial people are really happy because they're saving a portion of $85,000 a year in cost. What we highlighted, what we got the financial people to start thinking about was it's not just a cost savings, it is an opportunity cost. Because that person who you're not paying is also not producing 2.8 times their pay in value for the organization. And this is a professional services firm. So it's very direct, people to revenue creation, revenue support, and revenue creation. So what we said to the financial people was, instead of thinking about how can I cut heads to drive up productivity, because productivity is revenue divided by full-time equivalents, right? So instead of cutting down the denominator to make the quotient bigger and go to management and say, our productivity is so much higher, the idea should be, how many people at $85,000 a year can I hire that's going to generate $280,000 of value for the organization, right? And because they're client facing, it's customer service reps, it's, people who are processing benefits, it's all service driven, like a bank. Banks can't make money if they don't have people in branches and they don't have people processing loan applications, right? So you need people. And the financial people sort of took a step back and went, oh yeah, you're right. The more people we have servicing clients, the more capacity we have, the bigger our company can grow and the more value we create for our stakeholders. And these people are relatively inexpensive compared to what value they're generating. Now, it's not scientific, because I'm sure there's a point of diminishing return in terms of staff and headcount. But the general idea is when people are creating more value than you're paying them, you want to grow your staff, right? As long as the market can support that. And the other thing that we pointed out to them was The longer a job stays open, the more costly it is to the organization. So every day that a job is open costs the company $18,000 in an opportunity loss to revenue. So think about attrition in a different way, right? What I say is you can't drain the car of gasoline and expect it to get to your destination. You can't cut heads, cut staff, cut talent from an organization and expect it to be around very long. It's not sustainable. And it's not sustainable because people are the unit of value creation. And when you overload people with tasks and jobs and accountabilities, you burn them out. So they're diminished in terms of their ability to produce. Trevor, also good point. So there's a point of view that every employee is actually a client server, some type of a server, right? Support. So the way that I like to think about it is you can identify in your organization who are the direct generators of revenue and understand that relationship between cost of that employee group and revenue, and then understand on the cost side, the staffy jobs, what their cost is, and the size of expense that they are supporting in the organization. So you can slice and dice the organization in different ways to try to get a handle on revenue generators and support staff. But remember, the revenue generators can't do their jobs without the support staff, right? Brokers, insurance brokers can't sell policies without actuaries. They can't make the company successful without the back office claims processors and customer service reps. So every person in the organization contributes to the success of the organization, either directly or indirectly, to that profitability number. Does that make sense?
That's great. We are coming up on time. I have one fast question for you because it came out in the news and we have to ask. On Tuesday, the FTC announced that they are going to ban non-competes for employers to enforce non-competes. Now, there'll be some exceptions around executives and if you've paid people and so forth, but overall, that's a pretty big statement. Now, immediately following, our friends at the Chamber of Commerce has now sued the FTC, and we're going to take this to the courts. The courts decide. What's your thought on how this is going to play out for companies who have relied on these non-competes to keep people maybe longer than they want, either in their own hands or out of the hands of their competitors? And how do you think it's going to play out? Or do you have a crystal ball?
I don't have a crystal
minute.
ball, but I do have a point of view. And the first thing you need to understand is those non-competes are only related to employment. They do not, the IP, intellectual property, or any trade secrets are still covered by agreements. So you can't, employees can't leave companies and take intellectual property or take trade secrets and go someplace else. The only thing that they are banning is the employees being able to pursue work at a competitor company, not take any assets or property of the organization. So basically, it's just going to create more fluidity in the market. And it's, I think, in one sense, it's going to unplug the court systems because the courts usually come down on the side of an employee because you cannot prohibit someone from earning a living in their profession, which means that companies can't say, you can't go to that company or this company or that company. So I think it's going to unclog the courts in these types of lawsuits, but it also might create more lawsuits around intellectual property as the tort. So it's employee friendly, that's for sure. At the same time, it could be company friendly because people that you were prohibited from hiring in the past that were covered by a non-compete are now fair game to you. So I think it goes both ways. I think there are risks and opportunities on both sides, and we'll see how the courts decide on it.
See what happens. Thank you everybody for joining us. Next month, we have Luke Eaton joining us. He is the leader of recruiting operations for Welltech out of the UK. And he has, he's a prolific writer. He has a newsletter. He likes to talk about the data, how you use data, how you think about data in your recruiting operations, and how you can operationalize it to storytelling to get outcomes in your business. So please join us. You guys will see that come out in an email shortly. We will have this recorded and we'll send it out. And as always, thank you guys for joining us. It's been great. Thank you, Dr. Charles, for joining us. So
Thank
nice
you.
to see you again.
And I'll see you
Appreciate
at the next one. As a data wonk, I'm all in.
Oh, you're all in. Oh, you're going to be great. So it's going to be on the 16th at 11 a.m. Eastern, 4 p.m. UK time. So see you all there. Thank you.
Thanks, everybody.
Bye now.
Bye.
Bye.